This is FinTech Insider News. This week, the UAE overtakes the UK in global FinTech rankings. We take a closer look at PayPal's new Pay with Crypto feature, and Wise announces which country it will be listing in. We'll be discussing all of this and more on today's news show, so don't go anywhere.
Growing your e-commerce business comes with plenty of hurdles, but shipping shouldn't be one of them. Well, here's some good news. Powerful e-commerce shipping software called ShipExcel from Pitney Bowes. With ShipExcel, you can generate discounted shipping labels for both online and offline orders. That saves time and money, with everything right at your fingertips. Start your free trial of ShipExcel from Pitney Bowes today.
On WhatsApp, no one can see or hear your personal messages. Whether it's a voice call, message, or sending a password. To WhatsApp, it's all just this. So whether you're sharing the streaming password in the family chat or trading those late-night voice messages that could basically become a podcast, your personal messages stay between you, your friends, and your family. No one else. Not even us. WhatsApp. Message privately with everyone.
Hello and welcome to episode 985 of FinTech Insider, brought to you by 11FS, the 5-time Consultancy of the Year that works with banks, challengers and fintechs to build the next generation of financial services. I'm Laura Watkins, Director of Media Marketing here at 11FS. School might be out for summer, but there's no slowing down in the world of fintech. We've got a jam-packed news show for you today full of the biggest stories shaping the industry right now. So whether you're tuning in from a sun lounger or staying closer to home, our guests are here to make sense of everything happening across the fintech landscape this week. So let's meet our panel. First up, we have my 11FS colleague and co-host for today, Russ Gallagher, Head of Consulting at 11FS. How's it going, Russ?
Yeah, really well, thanks. I'm looking forward to this.
Yeah, it's going to be fun. Russ, last week you published an article that had a lot of people on our socials talking. You talked about the industry being in survival mode and why it's crucial for financial institutions to innovate with purpose right now. Can you unpack that a little bit? Tell us a bit more about it.
Yeah, absolutely. It came off the back, actually, of a conversation that I had with Kate Drew and our own David Barton Grimley on this podcast. And the thought sort of stuck with me. You know, I think we all feel a little bit like we're in survival mode as individuals at the minute. But, you know, I think that's also true of financial services as an industry. I think after a decade and more of innovation, I think, you know, we've sort of gone back to maybe becoming a little bit more insular because the challenges that we're facing internally are enormous. And so it's really just I suppose a call to arms. You know, it's really important that we don't just lose track of the customer, that we don't lose track of what's happening on the competitive front. And as you say, that we're really careful in innovating with purpose and making sure that we're also keeping our eye on those long-term goals. So if you haven't seen the article, you can find it on my LinkedIn and feel free to connect. I'm always happy to chat.
Brilliant. Thank you. And also, yeah, we'll probably share the link in the show description as well for anyone who wants to find it. Next up, we have a FinTech Insider return for Sophie Guibaud, Strategic Sparring Partner at Building Alpha. That's a very intriguing job title. Welcome back to the show, Sophie. What have you been up to since we last spoke? And can you unpack that job title for me?
Yeah, definitely looking to keep things intriguing. So no, I have, since I last came, I've moved on from Fiat Republic and I have switched gears to actually becoming growth sparring partners for B2B fintech founders, or B2B tech, B2B fintech funders, helping them basically putting in place founder-led growth systems and supporting with everything growth related. So that's the first part. Second part, I'm doing lots of advisory with banks when it comes to, specifically in the Middle East, when it comes to embedded finance, banking as a service, which are hot topics. And I'm also an independent board member at financial institutions. So it's pretty cool. I'm really happy with that because I get to see everything from early stage to big corporates and still very close to fintech.
Amazing. And yeah, I'm sure that brings you a lot of insights, all of which we hope to dig into across this week's stories. And next up, we have Mike Carter, Senior Policy Advisor at Innovate Finance. Welcome back to FinTech Insider, Mike. Could you tell us a little bit more about your role at Innovate Finance?
Sure. Thanks, Laura. Thank you for inviting me back onto the show. Innovate Finance, for those that don't know us, we are the trade body for fintech in the UK. I particularly look after the capital investment programme, promoting investment into UK fintech. We publish reports every 6 months on investment into the sector. We have programmes to link up fintechs with VCs, and we advocate for government policy to try and help investment. So areas such as the Mansion House Compact and the Mansion House Accord.
Amazing. Thank you. And it's almost like we booked you specifically to talk about a story that taps exactly into that. So I think we're going to jump right in to that, actually. So our first story today is that the UAE has usurped the UK in global fintech rankings. This story was on Finextra. The UAE has recorded a massive $2.2 billion in fintech investment in the first half of 2025, driven largely by a landmark $2 billion Binance deal. This surge has propelled the UAE to second place globally in fintech investment and has overtaken the UK, which raised $1.5 billion in the same period. For context, the UK secured $5.1 billion total investment in 2023, enough to hold second place at the time, ahead of India and Singapore. However, Dubai's DIFC and Abu Dhabi's ADGM are central to the UAE's growth, serving as home to more than 60% of the UAE's fintech firms, supported by regulatory sandboxes, open banking initiatives, and a rapidly maturing digital asset infrastructure. In 2024, the UAE's fintech ecosystem was valued at $3.16 billion, with projections pushing that figure up to $5.71 billion by 2029. Right, there was a lot of numbers that I just read there. Ross, what was your initial take on this? Obviously, it's kind of a big deal that the UAE is suddenly kind of pushed the UK into third place. Obviously, the US is always kind of number one in these things. But, does that surprise you? And how much do you think the Binance deal was sort of driving that? But is this momentum going to be sustained, or is that a one-off, do you think?
Yeah, a couple of really interesting questions. Look, when I read the story, of course, it's going to grab headlines and it's going to get reaction. I think we like to think of ourselves as a heavy hitter, a big global player when it comes to fintech, and particularly fintech investments. And that's certainly been the case for a really long time. What I would say is that we've been on this current track for a little while, right? There have been lots of different issues, I think, that have contributed to undermining our position as a major player in that space. I don't think Brexit has helped. Some of the valuations that we've seen, we're not seeing valuations certainly anywhere near the sort of ticket price that we've been used to. So I think, again, a lot of that later stage funding is you can't exit, so it's gummed up in the system. That's an issue. And I think one of the things that we've talked about a lot is, and I know something that the government is looking at closely is, trying to get more pension funds invested and trying to encourage more people to invest in the market, and so make it more attractive. So I think it's a known issue, but I think the encouraging thing is that there are lots of initiatives in play specifically designed towards addressing this issue. So what you'd like to assume from that is that we're sort of heading more towards an upward trajectory rather than maybe the downward trajectory that we've been on for the last little while. In terms of the question about how sustained this is going to be from the UAE, is this more of a one-off? I mean, obviously, when you're looking at a $2.2 billion total and a single deal with Binance making up $2 billion of that, it naturally raises those question marks. Sophie, as someone who's out there in the region, I'd be interested certainly to get your thoughts on that one. You're probably better placed to have a view on that than I am.
Sure. Thank you, Ross. Looking at this article, totally agree with the focus on the headline and the fact that Binance is definitely what makes UAE jump in second place right now. However, I think what's important is more to look at a bit the macroeconomics and the dynamics that are happening in the region right now, because as much as maybe they won't be number two next quarter, what I find very interesting from living there in Riyadh for now a bit more than a year is the focus of UAE, Bahrain, Qatar, and Saudi on putting fintech as one of the main driver of their economy. So there is definitely the willingness from the top to put it front and center. There is regulations that are following. So on the UAE side and Dubai side, it's very much everything about consumer, fintech. They really want to launch the next Stripe or the next Revolut. They are putting the infrastructure in place, the regulation in place, the capital is in place as well. On the Abu Dhabi side, it's more institutional, it's digital assets. So they are very, very complementary, but they have really put in place the infrastructure that's required to create like a really great fintech system or ecosystem. On the Saudi side, Vision 2030 wants 525 fintechs in the next 5 years. Right now, we are a bit more than halfway. So they are really doing a great job. And like the people want fintech, they are digital, they are young. So as much as maybe they won't be number 2 in the next quarter, I would put a big bet on the fact that they will count more and more. And one of the things that I strongly believe is that there will be a global leader stemming from one of those jurisdictions, basically.
Amazing. Thank you. That was a really useful kind of regional take on it. Mike, if we kind of come back to the UK perspective on this, obviously as someone in your position that's kind of looking at the regulatory piece, looking at investment in this market, what is the kind of knock-on effect on the UK? Do we need to do anything differently to kind of start, the momentum that the UAE are obviously showing and that we have to compete with? What do you think the perspective is in the sort of home camp?
So I think it is a bit of a wake-up call. I mean, the article, it quotes the numbers from the report we published last week. And to give you a bit more context behind the numbers, so yes, the UAE has leapfrogged the UK with that one deal, but there's a bigger picture. When you look at the numbers, India is just behind the UK. So it's only about $150 million behind the UK so far this year. And in the 10 years we've been publishing the numbers, the UK has almost always been second. China had a brief appearance in second spot once or twice early on, but otherwise the UK has really held that spot. So the UAE may or may not hold that position for the full year, but there are other countries like India, like Singapore, who are catching up. The UK used to be larger than the rest of Europe together. Now that isn't so. The other European countries are catching up. So, we had a discussion as to why is this? There's been I think a structural and cyclical downturn in investment in the last few years. It's affected the whole market, not just the UK. And it's partly because the growth at all costs approach that VCs have had has been replaced with a much more considered approach to how they make the investment. So there's been almost like a pause for a couple of years. And also the VC firms themselves have been struggling to raise their own money. And the UK has been impacted the same, possibly more heavily than some of the other countries. And I think where we sit, we're looking at what's the next wave of innovation that's coming. That's things like AI-driven businesses, stablecoin, crypto. And we think that's going to really influence the next phase of investment over the next 5 to 10 years. And the UK has really got to make sure it is positioned for that new wave of technologies. It can't rely on the fact that it's been number 1 in Europe and number 2 in the world for the last 10 years, because all bets are off and it starts again.
What has to change to make that happen? So we all agree that that's what the UK needs to do, but how does one get there? Is that a regulatory thing? Is it a government-driven thing? Is it a combination of many factors? What do you think?
Yes, it's a couple of things. On the regulatory side, there are some very clear areas. Obviously, if you take AI, the EU has published its rules, which are not particularly popular with people in the EU. So, the UK has a potential to get advantage there. The UK approach of principles-based approach sounds good, but it isn't necessarily perfect. I was talking to one of our startup members this morning. They are looking to launch a wealth app with AI-driven portfolio building, portfolio planning and execution. And they were saying at the moment they don't feel there's enough guidance from the FCA to know how AI or AI solutions are going to be treated if and when there's a look back in the future. So that I think really needs to be buttoned down in order for companies to have the confidence to use AI in front-end applications. Another big area is stablecoin, where obviously the US is really powering ahead now. The UK, everyone is set to power ahead, but the stance of the Bank of England is diametrically opposed. at the moment, and that's a problem. And if that isn't solved, then the UK is going to fall behind. So there's a couple of very clear regulatory areas, and then I think on taxation policy, in the past, I think the UK was always viewed very favourably amongst European destinations in terms of its taxation policy. It's still not bad, but directionally, it's been getting worse in the last few years. And so I think the sentiment is concern from entrepreneurs around where's it going to go next? Is it going to carry on getting worse, or has it bottomed out? And that uncertainty will cause people to think, well, where else could I set my business up?
Yeah, absolutely. And I think we're almost on time on this one, but Ross, I want to kind of give you the last word, almost in light of the article that you were talking about in terms of like innovating through crisis and, not just sort of sitting back and pulling back to base. How would you kind of assess the situation from what the UK's got to do with that sort of lens on it? You were kind of nodding along as Mike was talking there.
Yeah, look, I mean, the challenge for the UK is to sum it up really simply, become much more competitive. And there are layers to that. Part of it, picking up on Sophie's point about the macroeconomic picture in the Middle East, the macroeconomic picture over here has been, it's not been great. It's been very unstable, and that affects things. I think for regulation is so important. What Mike was saying, sort of bringing that to life a little bit. One thing that we see a lot is, when there isn't that clear guidance from the regulator, that actually really does affect the level of ambition that we see in financial services. It's you are on the side of caution approach. If you look at things like the difference between giving financial advice and financial guidance, and there's a lot that you can do to play in that space and actually add a lot of customer value. Generally, what we see is that because that line isn't exactly clear, you get providers just disengaging and not sort of playing in that space at all. So it's an example. I think things like retrospective punishment need to change. The regulation changes, and then we can sort of punish you for stuff that you did under the old regulation in perpetuity. Again, that really hits sort of risk appetite and ambition. But as I said at the top, I do think genuinely that there are a lot of things, that we're starting to see that will start to address some of these issues and are very much geared towards driving that increased competitiveness. Rachel Reeves, as Chancellor, has talked a lot about, growth being a real priority. She's given the FCA, the PRA, the mandate to prioritize growth and really lay that framework. Everything that we're seeing with CFIT and all of that sort of stuff. And of course, Mike, you and your colleagues over at Innovate Finance really sort of driving that agenda around innovation. But ultimately, we have to make it more competitive for later stage fintechs to exit in the UK. That's what frees up all of the capital. That's what then goes back into feeding the ecosystem, funding those new emerging early stage startups. And that's really what gets the flywheel going. So look, there's lots to be done. I think it's a known issue. I think they're already pushing hard on a lot of those drivers. And so I only hope that we start to see that feed through in a bit of an uptick.
Yeah, definitely. And I think obviously having someone snapping at your heels always helps to get people moving as well. Exactly. So there's probably no bad thing in that either. I'm going to move us on to our next story, which is that PayPal has unveiled a pay with crypto feature. So PayPal has unveiled a new service called Pay with Crypto, enabling US merchants to accept over 100 cryptocurrencies, including Bitcoin. At checkout, payments are automatically converted into either fiat currency or PayPal's stablecoin, reducing volatility for merchants. Transaction fees start at 0.99%, which PayPal says is up to 90% lower than typical credit card international fees. The feature opens merchants to a global base of 650 million crypto users and covers about 90% of the $3 to $4 trillion crypto market cap. The launch follows regulatory developments like the Genius Act and positions PayPal in direct competition with platforms such as Stripe and Coinbase, which are also expanding their own crypto payment tools. Sophie, I want to come to you first on this one. Obviously, you have moved on slightly from Fiat Republic, but I'm sure you still have your finger on the pulse of crypto. What do you make about this one? What does that kind of say about PayPal's ambitions with crypto and sort of the enormous market share they could have by a move like this?
I think it's really interesting, and this is definitely the moment where PayPal starts moving from seeing cryptos as an asset class to a real payment for merchants. I don't think it's PayPal becoming fully crypto platform. I just think it's about access. On one hand, enabling the merchants to accept payments in different currency, including crypto, and getting the users to be able to pay with crypto. So for me, it's the very early stage of using crypto as a payment method and not as just an investment tool. So I think that's mainly about that. Something to note, though, is that it's about bridging crypto with the mainstream, right? It's about wallet integration. It's not about Web3, DeFi, etc. So it's a step in the right direction, but it's still a cautious step. However, let's see in a year time where we are at in terms of adoption by the merchants. I think it's going to be very interesting, because with this ability of the merchants still being paid in fiat and stablecoin, and the uptake that we are currently seeing in stablecoin, we could have very interesting results, I think.
Yeah, it's such an interesting point in that, they can offer it, but merchants have to take them up on the offer, right? And if they want to be paid in cryptocurrency. So it's almost like open it up and see who has the appetite to pursue it. Would that be fair to say?
Yeah, exactly. That's not compulsory. So let's see what's the uptake when it comes to merchants, and then when it comes to consumers. But that's definitely a step in the right direction, and it's where the market is heading. But it's still early stage, and it's what we all know or need to understand, basically.
And Russ, to Sophie's point, this is moving away from the kind of Web3, the more Wild West aspects, and moving towards a sort of more of an infrastructure play. This seems to be happening a lot at the moment, more so on the sort of stablecoin adoption than maybe traditional crypto. But do you think we're going to see even more of this, where people kind of are using crypto as an asset class and using the infrastructure behind it to kind of integrate into traditional financial services more and more?
Yeah, in many ways, I think it's kind of classic hype cycle stuff, right? You have that sort of technological breakthrough, and you have your sort of early adopters, and their kind of narrative is, fiat currency is dead and this is the future and everything's going to be decentralized. And I think, look, we may well still get to a version of that future, but I think the reality is that that's always, we've seen this time and time again. It's a lot less big bang than some of those early adopters predict, and actually it's a lot more gradual. I couldn't agree more with what Sophie said about it's another big step on the journey to crypto becoming mainstream. We saw another huge milestone when Stripe started facilitating crypto payments as well, right? You're talking about, you mentioned, I think 360 million or so crypto users. You're also talking about, tens of millions of PayPal merchants, right? And so you're connecting all of those, and you are the potential here for me for crypto adoption is huge. Sophie quite rightly pointed out that you need the uptake from the merchants, and not all of them will go for it. But if there is a significant uptake, then does crypto adoption then become more? Do we start to see that rise as well among the general population? Probably. So in that sense, I sort of read this story initially and kind of went, oh, that's cool. And then kind of thought about it and went, oh, this is potentially huge. And so, yeah, well done them. I think it's a cool story.
Absolutely. Mike, what was your take on it? What does it kind of mean for PayPal in terms of their intentions of taking on Stripe, Coinbase, that massive sort of network play of as Ross said, sort of linking the enormous market of crypto users with the amount of merchants they already have?
Yeah, no, I think it's a very it's always an obvious thing for them to do, because they're a leading payments company, and you would expect them to be in crypto and stablecoin. I think there are a lot of views that say in 10 years' time, stablecoin will be one of the leading retail payments methods, but we're not there at the moment. So I saw some data recently that said that transaction volumes in stablecoin are higher than they are, daily transaction volumes are higher than they are for Visa and MasterCard. But 80% of stablecoin transactions they're all around crypto trading. People are using them to trade them that crypto assets. So stablecoin is not being used for payments, whereas lots of people with crypto are using their crypto for payments. Now, logically, over time, you would think that's going to transition from crypto being used for payments to stablecoin being used for payments. At the moment, people buying crypto don't necessarily want to buy stablecoin and use it for payments other than for their trading. So I think PayPal is giving themselves full optionality. They're looking at what the customers have, which is all sorts of different types of crypto assets. And certainly for the merchants, I think it's really good from a cost perspective, and that is why they should be attracted by it. Over time, I would expect to see a complete shift towards stablecoin payments coming through instead of crypto, and crypto being more for investments, trading, speculation. But at the moment, that's crypto is where the payments are being made rather than the stablecoin.
Interesting. Sophie, would you kind of agree with that approach of like almost a flip reverse coming in terms of consumer behaviors of how they use both crypto and stablecoin?
I think it's an interesting point. I would expect this trend to be even stronger when it comes to corporates, I would say corporate payments, because really I believe that a lot of the uptake that we have seen when it comes to stablecoin in the past, let's say 18 months, has been driven by cross-border transaction when it comes to corporates. But I would expect as well, indeed, that the retail will follow. Another point actually is that I have been thinking of when it comes to for the merchants to actually receive even payments when it comes to stable coins, etc., and even accepting it in crypto. Here we are talking, like PayPal enables them to take it in fiat and in stable coins. Eventually it might be in crypto, but there will be something from probably the PayPal side to be done to make sure that like it doesn't become a massive headache for them in terms of like tax implication, accounting, etc. So like there is also this barrier to take care of.
How you work it out at the other end. Yeah.
Yes, exactly.
And how to get it out of a wallet and all the rest of it if you don't want to just re-transact in crypto, I imagine.
My understanding is that PayPal isn't actually mandating that they convert it into fiat or stable coins. They will actually allow merchants to transfer the crypto into a linked wallet like OKX or Coinbase or MetaMask. So I think they're already sort of heading in that direction, as you say.
Interesting. In terms of like the actual average person that holds crypto, and maybe this is a question to you, Sophie, from your kind of experience in this market, do you think people actually want to spend their crypto, or are people still in that kind of hold, speculate, use it as a sort of nest egg, as it were?
I think we are like definitely still at the early stage. So people that hold the crypto, that hold their Bitcoin, the holders, the ones that are trading and just trying to place what's basically is a bit bets when it comes to like making transaction and day trading around it. I believe that like when even if you're a hodler, when your crypto is high, you have more propensity for sure to spend it or to buy stuff with it, because you're just like, oh, I just paid like my Bitcoin that much, but right now it's that much. So like essentially it doesn't cost me much. So I think there is still this thinking rather than jumping into, oh, I can make crypto payments. But we need to think also about the people that get paid in crypto to optimize taxes, I would say. And probably some of them are very happy to be able to make crypto payments. So I would say it's still a step by step. I still remember when I was at Bitcoin Miami and I paid my tacos in crypto. It was a pretty cool experience, to be fair. But it's just because I'm a fintech and crypto geek.
I hope that it wasn't something you regretted, as it, the infamous guy that bought pizza with Bitcoin that, could have been worth thousands.
It was too late. Like Bitcoin was too high already.
Fair enough. Russ, what were you going to add?
Just, I suppose, looking at that question from a slightly different angle, PayPal aren't rolling this out because they're crypto fundamentalists and, they really want to spread the word of crypto. They're doing it because, the merchant appetite is there. They're doing it because the customer appetite is there. They're doing it because the business case stacks up. yes, there's absolutely advantages to being an early mover in this space. But yeah, I think I think we can safely say this is a trend.
Yeah, I think Mike, you kind of alluded to it as much as like, they kind of have to do this to kind of keep up. Would that be fair to say?
Yeah, no. I think that's right. One crypto firm said to me recently that even though there's so much work going on around stable coins, it's still quite a slow burn in terms of, if we like, retail adoption. They said it'll become a mass market product when retail don't know they're using it. So most people are not going to want to know what a stable coin is. They just want to make a payment like they do with Apple Pay at the moment. They've got no idea what's going on under the bonnet. And that's when it should hit mass adoption.
That's when you know it works, if people don't know how it works, in a way. And on that note, we're just going to take a quick pause. Back very shortly.
This episode is brought to you by Nordstrom. Summer's almost out and fall's calling. Luckily, Nordstrom has everything you need for the season ahead, all under $100. Discover new arrivals from your favorite brands like Mango, Princess Polly, Wave, Free People, BDG, and more. Whether you're planning a last-minute getaway, heading back to class, or refreshing your office looks, you'll find the latest trends and beauty must-haves without breaking your budget. It's easy, too, with free shipping, free returns, and in-store order pickup. Shop today, in stores, and at Nordstrom.com.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider.
Welcome back. Before we get back into the news, we wanted to share our latest Insights episode with you. Small and medium-sized businesses, or SMBs, are the backbone of the global economy. But despite their vital role, they're still too often overlooked and underserved. In this podcast episode, we're putting SMEs back in the spotlight, and for good reason. You might be thinking, haven't we covered this before? And yes, we have. But in 2025, the challenges have evolved, and so must our solutions. So how can we better meet the needs of SMEs, not just locally, but globally? The episode is out now. Just head to the podcast below this one. And now back to the news. Our next story is NatWest adopts Pexa digital remortgage platform. This story on Finextra. NatWest has signed a formal commitment with Pexa to integrate its digital property exchange platform for remortgage transactions, with go live expected by mid-2026 and plans to extend into sale and purchase settlements. Pexa's platform aims to accelerate remortgage processes, cut administrative burden, reduce fraud risk, and enable faster, more transparent digital transactions via automatic data exchange between all parties. Built on Pexa's Australian success and UK trials, remortgages that typically take weeks can now be completed in as little as 36 working hours and sometimes within 48 hours. Pexa's plans to launch its broader sale and purchase solution in autumn 2025, covering over 70% of property transaction types in England and Wales, with NatWest intending to adopt this functionality later in 2026. So Ross, I want to come to you first on this, sort of working with tier one banks as you do. How is this a sort of significant step from NatWest to adopt a sort of digital platform such as this? And what does it show from their side in terms of their intent?
Yeah, look, I mean, it's funny, isn't it? I mean, when you read some of this, I suppose it kind of serves to underscore how broken this process is, right? Mm-hmm. So just to repeat some of that back to you, cut administrative burden, reduce fraud risk, enable faster, more transparent digital transactions, automatic data exchange. By adopting this, NatWest admits they have all these problems. Right. And so these are all things that, absolutely we should have. I think the partnership with Pexa makes a ton of sense, right? Because the process, it's such a good example of the difference between digitizing a sort of existing analog process versus what does this look like in a truly digital context, right? We kind of went, mortgages work well in a sort of branch-based environment where I can sit down with someone and they can sort of handhold me through that process. They can verify my identity, they can do all of that, and then we walk away and we're kind of in a good place. Trying to replicate that process when you are one step removed in a sort of online environment becomes really, really, really painful. And guess what? The pain sits with the customer, right? It's kind of okay, you can't come to a branch anymore because branches and people are really expensive. Just do it online, and actually you're going to have to take all of the load and the burden. So, I mean, fixing this process, and we've had, so many conversations with banks down through the years around this, has been such a high priority for so long. But yet, certainly when it comes to the bigger banks, we haven't seen much by way of material progress. That's why I think actually this as a step forward is a big one. Anything that we can do to improve that process, which is fundamentally broken for customers, absolutely we should be doing. It should be a big priority.
Definitely. And I was joking that like NatWest have kind of acknowledged that they have all these problems by making this partnership, but like the first step into solving a problem is to acknowledge you have one, right? And so in that regard, it's kind of refreshing that they're taking steps, and also, if you can't do it yourself, partner with someone who can. And so, Mike, what was your take on this? NatWest have 12 and a bit % of the UK mortgage share. So, they're not as big necessarily as some of their competitors, Lloyds, Barclays, Nationwide, etc. Do you kind of think this might set a trend in terms of other big bank providers starting to look at more digital solutions? Because as Ross says, digitizing of an analog process isn't really working at the moment.
Yeah, no, I mean, it's very, very welcome to see some progress in trying to digitize the process. This is one of the biggest markets there is in the UK, the residential mortgage market, in terms of loan volume, in terms of fees earned, and obviously in terms of importance of decision for the customer. So it's a market that should be ripe for digitization, but hasn't really managed that. And it's been quite a difficult market for fintechs to try and get into. It's very difficult to compete on funding costs on mortgages if you're not a big bank, and that has really got in the way of anyone being able to get into this. But anything that can improve the processing has to be good in terms of getting the market to a better place. I think that could lead to greater disruption, greater opportunities for new entrants, and it should lead. You would hope one day that the whole household property buying process is going to be automated. It'll be on blockchain, and that'll make it much more accessible for other participants in the market, and perhaps bring more competition to the market.
Yeah, I mean, let's hope so. I mean, to your point, yeah, fintechs have struggled in this area, but not necessarily in like they haven't had huge success in the entire home buying process, but like in these little niches that Pexa is an example of, they seem to be doing well, and then being like kind of acquired by banks, which is an interesting way of kind of still solving the problem.
Yes, no, I agree with you. So people have been building businesses around the edges, bringing more efficient processing into the sector, and that is definitely good for the market, and it would be great to see more parts of the market being attacked like this in order to make the market more efficient.
Definitely. And Sophie, interested in your sort of international view. Obviously, we talk a lot about at 11FS about how the home buying process is broken, usually with a bit more of a UK lens on that. Like, would you agree? Obviously, you're based in Saudi. I don't know if you have property buying experience in Saudi, but also in France, and you're very well traveled. Would you say that the process is broken sort of universally, or are there any learnings we can take from other markets?
No, so I think the process is very much different from one market to another. So my experience stands in the UK actually, and in France. In France, we have the beauty of not having to remortgage. So I am currently on the 105% forever.
Wow.
So that's actually like one of the perks. We don't have like credit scoring. It's just different. It's a different market. So we don't have like the remortgaging thing, but like having gone through multiple times in the UK, the remortgaging, it's a no-brainer. It's something that needs to be tackled. But it's not only the remortgaging, it's like the full mortgaging process and like all the intermediaries. It's like the whole value chain. And from what I understand from what Pexa is doing is that actually they are in the middle of this value chain. And I find it's very interesting and compelling. And to the point of the partnership between NatWest and Pexa, I think, it's what we have seen arriving, like with the different banking as a service platform, 10x and like Zout machine and like Membu and all of those. That was the first layer. Those, I believe, are probably doing also some mortgage applications as well. But it's vital for banks to actually collaborate with like tech providers that know what they are doing and focusing on solving one problem. Then the banks on the other side, they need to basically align all their processes, all their people, the customer experience. It's a really heavy lift, and I find it very brave from NatWest to take this leap with like 13% of the market. And I believe it should be a first step for the whole market to actually take the leap.
Yeah, definitely. And I think also Pexa is sort of FCA approved and also handles accounts for solicitors as well. So they're kind of handling the other side of the value chain as well. Ross, kind of, does that build on Sophie's point about them being like a real sort of network player and the kind of impact they could have for NatWest as a result as well?
Yeah, 100%. And the impact that they can have for customers, right? I mean, anyone that's been through the home buying journey, and I know we all sort of try and put it to the back of our mind once it's over and sort of remember it and shudder every so often. But I wouldn't underestimate the power of the sort of automatic data exchange between all parties element. I mean, anyone that's been through that process will have, how many times have you been asked for the same piece of information a dozen times by all of the different parties, and sometimes even by the party that you've already given it to, and it's your fault, you got to go and rectify it. So that network, that Sophie, I think you use the word ecosystem, I think that's absolutely spot on. There's so much that can be done to grease the wheels between all of those different parties who, as it currently stands, are operating completely independently, completely in silo. And that pain is on the customer to go and bring all of those things together and put ticks in all of the millions of boxes that all of them have. So I think that's key. As well, and I don't know if this is part of it, but I've just been thinking, this whole thing around like wet signature, like we have technology solutions for as long as we've probably been here that solve for this problem, and yet some of these institutions still insist on wet signature, print it off, post it to us. And as much as I think there's a lot that players like Pexa and NatWest can do to solve for some of these technological problems, that's an operational and a risk problem. And so I think you also have to bring that in line with what the technology can deliver before you can really actually realize the full potential of what we're talking about here.
Definitely. I think there's a lot that needs fixing across the entire home buying process. But, what we are saying in short is that this is a good step in the right direction. So well done, NatWest, well done, Pexa. But if you want to know more about that is 11FS's thoughts on home buying and how to fix the process, then good news, because we wrote a whole report on it. You can check it out at 11fs.com/home buying, and we'll stick a link in the description of this very podcast. And on to our next story, which is that Wise votes in favour of a US listing despite share class controversy. This was in UK Tech News. Shareholders have overwhelmingly voted in favour of moving Wise's primary stock listing to the US. The one vote package also approved a 10-year extension of Wise's dual-class share structure, originally set to expire in 2026. Despite vocal opposition, shareholders, including institutional backers, prioritize Wise's growth strategy and market access over governance critiques, according to the Wall Street Journal. This listing is expected to enhance its visibility in the US market, which is cited as the primary growth opportunity. Wise currently has a market valuation of around £11 billion and plans to maintain a secondary listing in London even after the US move. Mike, maybe let's come to you first on this. I think obviously Wise kind of a UK HQ'd company. I think the hope was that they would list in the UK, but the way the wind is blowing for most of these things, the US is sort of tending to win out here. What do you think the impact of this is? And, is there any light you can shed on the kind of controversy as to why they think there might be a governance risk here?
Well, there's no getting away from it. It's a shame for the UK market that Wise are going to move to the US in terms of their listing. They're a great business. They listed quite early. They've been very successful. So it's a shame to see them go. I think they're a little bit unusual. Obviously, they already had the dual share structure when they IPO'd 4 years ago. The UK didn't allow a dual share structure for a premium listing, and the stock exchange had premium market and standard market. And premium listing, you got into all the indices, and the standard listing, you didn't. And they were not eligible for the premium listing because of their dual share structure. Despite that, they floated, they got a very big market cap. And then over the last few years, the FCA changed the rules on dual share structures. The Khalifa review, which came out just before they listed, recommended it. The Hill review recommended it. But it took about 3 years for all this to change. And it was almost like a negotiation between the FCA and the market. The first consultation that came out had a 5-year sunset. It only allowed individuals to have it. And it iterated, and eventually it changed. But I think that was all a bit too slow. And I'm sure if you were the founder of Wise wondering about this, it'd have been you're not going to wait to see just in case the FCA changed to suit you. You're going to look at other options. And the US doesn't really bat an eyelid on dual share structures. And there may have been that comment about governance in the Wall Street Journal, but the FCA's own data in their consultation said companies with a dual share structure where the founder has control have outperformed other companies. They've said that in their own data. The poster child for that is Mark Zuckerberg in Meta, where he has a very heavy proportion of the votes, and he's had that for 13, 14, 15 years since they IPO'd. And the UK kept putting time limits on it, and everyone kept saying, let the market set that. If people can invest, if they don't like it, they don't have to invest. No one's forcing them to. So I think, unfortunately, that this all happened too late for Wise. And when you look at their numbers, in a year or two, the US will be their biggest market probably in terms of revenues. So, again, there are other commercial reasons. A number of other UK companies, not other sectors, have moved from the UK to the US in the last few years, and their market, the US has become by far the biggest market, and that's kind of in some ways that's logical if your biggest market is the US.
It's a growth strategy as well as a listing strategy. Russ, on the sort of the point about the kind of loss to the UK, as it were, are they almost kind of throwing London a bone of like, oh, we'll do a secondary listing after we've gone to the US? Like, is that just sort of, I don't know, little bit of a consolation prize? What do you think?
Yeah, it's tough. Look, the board of directors, their primary objective, their primary responsibility is always going to be to maximize value for shareholders, right? So in many ways, this isn't a major surprise. I couldn't agree more with what Mike said, that this really is a shame and indicative of a wider trend, as we talked about in our top story. But even Nick Storonsky over at Revolut has been quite vocal about the fact that the UK isn't an attractive market in which to list at the moment. I think T.S. O'Neill of Monzo has said, that they would also have to seriously consider the US.
I think that one was the biggest surprise, wasn't it? Because Revolut is like, fair enough, they are a fairly multi-marketed company anyway, so going to the US kind of makes sense. But Monzo, everyone thought that was like the jewel in the London crown. So I think it was a bit gutting when TS was like, oh yeah, we're going to be looking at the US as well, even though they don't have a huge foothold in that market at the moment.
And absolutely, I couldn't agree more. But again, the UK can't rely on the nostalgia that comes with being the home market as enough of a draw. As I said, the responsibility of the decision makers in these businesses is to maximize returns for shareholders. And so, as we sort of mentioned at on the previous story at the top of the podcast, it's really important that the UK offers a competitive environment in which to list, or else this trend is going to continue.
Sophie, I'd like to get your kind of international perspective on this. Obviously, us sitting in London kind of mourning our losses is a very UK-centric view. From your perspective, what do you think this says about, or like, what is the sort of global perspective of the London Stock Exchange versus the US, and you know, what can we do, much like the first story, as Ross was saying, to kind of regain that foothold?
Yeah, so I think I would like to piggyback on like all the comments that Mike has done. The thing is that, I mean, we are globally becoming more competitive. Clearly, like the US in that case is likely to become Wise first market shortly. Like the investors see that. They see also the fact that they will be able to attract probably more capital than that in London. There is the fact that it's more reputable and they can expect a higher valuation. So I think it's, it's kind of a no-brainer from a shareholder perspective. I think that there are other markets heating up when it comes to IPO. I can definitely talk about Saudi, that is putting an emphasis on that. There is also like UAE as well. And I have talked to many international companies actually surprisingly telling me, oh, we are thinking of doing an IPO in UAE. And I was just like, oh, really? But when you see that the Binance raised 2 billion, not through an IPO, but just as part of their story with like a private fund, then like if the capital is here, why not consider it, right? And don't get me wrong, as you all know, not Mike, but I am British, proudly so. And so I am definitely in favor of I want the UK market to succeed. But to do that, clearly, like Mike's recommendations, things are interesting. Another point I would like to make on this story, though, is about like the governance and the fact of pushing 2 decisions in just one vote. And I think, like to the founder's points, it's something that is a bit forceful. And it's 2 decisions that could have been kind of separate, and so it's very interesting to look at what has been done here. Is that, well, if you're in favor of the US listing, because clearly, like, it's what is important for Wise according to their development, then you had to also vote in favor of the maintenance of the dual class actions. And something noteworthy as well is they prolonged it for an extra 10 years. That's also very strong move. So I guess it's just a point of thought on the governance of companies and the fact that they should evolve as the company evolve. And
Yeah, no, it's definitely a point worth making, particularly as their own sort of co-founder has opposed this vote structure, and he's worried about the sort of legal ramifications. Mike, as our sort of policy expert on the podcast, kind of what was your take on that, the kind of 1 vote, 2 outcomes kind of method they went for here?
Well, I guess from the company and founder's perspective, they view them as interconditional, that they wanted the 2 to go side by side. I mean, the founder, clearly wants to extend the votes, and that's the bet that he's asking the shareholders to take. I mean, I think again, people, if they don't like it, they don't have to hold the shares. And that's kind of my view on these kind of market votes.
Fair enough. And then equally, just sort of, I feel like we've almost come full circle on this story. So as with our first story today of like, in terms of the competition element with the UK versus everywhere else, like as Ross said, you can't just rely on nostalgia of the fact that you've been sort of a leader or second place for as long as you have. Like, that's not enough. And I think it was really interesting what you were saying, Sophie, of like, the Middle East actually wants to be a competitor, doesn't just want to list in the UK, US, and that's your only options. They're starting to throw more options out there. So I think it'll be really interesting to see how that evolves and where, like, fintechs that haven't even been born yet eventually list when they're ready to as well. I think it could be a very interesting evolution of the entire system. But I'm going to move us on. A quick look at one more newsworthy story this week that we don't have time to cover in full, but we think you will find just as interesting. And this is that Australians embrace digital banking as digital wallet use surges. So Australians made over 4 billion mobile wallet payments in the past year, totaling approximately 160 billion Australian dollars or 130 billion US dollars, surpassing ATM cash withdrawals by more than 11 to 1. Digital banking has boomed, with 99.3% of all customer bank interactions now occurring via digital channels. And mobile wallets now account for 39% of debit and 33% of credit card transactions. And nearly 46% of debit and 40% of credit cards are enrolled in wallets as of late 2024. And the overall digital wallet market size is expected to reach 336.1 billion Australian dollars by 2029. I seem to be reading out a lot of numbers on this podcast, probably quite badly, but the point is enormous growth. Russ, as someone who has visited Australia fairly recently and regularly, what's your kind of take on this?
I think it sort of busts a common, or at least a semi-common, misconception in the industry that there isn't much sort of happening in Australia when it comes to sort of like digital innovation, sort of digital disruption and competition. I mean, some of these numbers are absolutely staggering, right? You've got mobile wallet payments like 11 to 1, sort of outstripping cash withdrawals. 99.3% of all customer bank interactions now occurring via digital channels. I mean, that's incredible. What I would say is that this is a really good illustration of what can be achieved with good, digital propositions and good digital servicing offerings. I mean, yeah, like you said, like you're reading out a lot of numbers on this show, and I don't envy you, but these are some really impressive numbers. I think we should all take note.
Definitely. Lots to learn from that. And obviously, I didn't say the only way is up for them, which it definitely is. But, if you're at 99.3%, there's only a small amount of percentage to convert. But yeah, we will definitely keep an eye on that one. And as you say, sort of, I think we tend to overlook Australia sometimes as not doing a great deal, but this obviously shows the opposite, which is great. And finally, our last story to chat through today, Revolut offers financial independence to 16 to 17-year-olds. Revolut now allows 16 to 17-year-olds to level up their financial independence, moving from a child account to a controlled personal account. The tiered structure aims to support financial literacy while retaining parental oversight and safety controls. It's a structured path towards full adult usage, which matures at 18, transitioning to a standard Revolut personal account with full features. This is an interesting choice, particularly as it only sort of spans a sort of 1 year gap from a child account to you kind of go to a full personal account age 18. Sophie, as a parent, you were talking about your children earlier. What do you think of this one in terms of the sort of financial literacy piece, but also having those parental controls while they learn as well?
I honestly think it's awesome. And the reason for that is because they get access to their financial independence while a lot of them are still at home and can do it still with at least the guidance of and the steering of their parents. I mean, personally, when I started managing my finances was exactly when I also left home to study in Canada. So I did everything at the same time. So I was okay-ish when it comes to financial literacy, like always had money to spare, etc. But I find it amazing to be able to actually control your finances and learn along the way, and much earlier than when you're thrown in deep water. So I like that. The second thing that I'm experiencing as a parent, so I actually just gave her first Revolut card to my daughter, 6 years old.
The kids card, presumably.
The kids card, exactly. That's linked to my accounts. But it has been actually a few months that she's getting some colored pompons for things that she's doing, and basically like pocket money. But it's literally for her. We started pocket money like 10 years before I started pocket money back in the days. So I believe that kids are learning or how to manage money much earlier. I don't think it's only me. It's just what they see, it's what they want to buy. It's like that type of thing. But I actually love the fact that it can be a much smoother road. So I am all in for that.
Amazing. Mike, obviously, Innovate Finance is very passionate about sort of financial literacy and that sort of thing. What's your take on this and sort of those parental controls on this kind of level up of a kid's card?
Yeah, no, I think it's great. I mean, I think Go Henry has had the market wrapped up for many years, and it's great to see how they come into the market. You know, the Revolut app and card are really good. It'd be interesting to see how they differentiate the service between the kids card, this card, and the adult card. But I think anything that helps that passage through to full cards is very good. And you know, my daughter's now at university. She had a Go Henry card. She found that really great in terms of using that for purchases.
What age do you age out of a Go Henry card? Just out of interest. I don't know the answer to that.
Well, I think 18 now. It has to stop at 18, actually.
Right. Okay.
So she then had to move out. But it certainly helps them. You know, one of her friends in the sixth form was taken out on a date by a boy who came to pay for the bill at the end in the restaurant, and they wouldn't accept it because Go Henry doesn't allow you to pay for somewhere that's got alcohol.
Oh, so interesting.
The boy had to ring his father to get him to pay the bill. So there are some definite life lessons to be learned from financial services.
A little shine off his street cred, maybe. I love that though. Russ, slightly different question for you. I was reading this story. Is 16 to 17 maybe too old? Like, as in, should you put some of these sort of ramping up phases in a bit sooner? I only asked because I had my first like actual job age 16, you know, was receiving a wage, that kind of thing. I mean, you can join the army age 16. Like, you know, should we be doing some of these things a little bit earlier?
I think it's important to sort of think of this product as transitional, fundamentally, right? Because I think Go Henry, Rooster Money, you know, the Revolut Child offering, I think are great propositions. I absolutely echo everything the other panelists said about them being an incredibly invaluable tool for learning good financial habits and behaviors that I think, you know, we didn't have previously. And to Sophie's point about getting in hot water, I think learned by doing things wrong and then feeling the pain. You know, that's I would guess that the vast majority of people's financial journey. But actually, you know, previously I think there was a bit of a cliff edge. You know, you had the child proposition, you had all of the supervision and controls, and that was a very safe environment. And so what this is offering is, you know, you don't have all of the supervisions. You can have a pay slip paid into it, for example. You can transact in the way that you want to transact. But then, you know, certain services, some of the more complex services, so crypto investments, for example, aren't available. And so I think, you know, it really is about that first step towards true financial independence, applying those good habits and behaviors that you've learned through the kids propositions in a more probably, you know, a more independent environment, as they said, before then taking the full step up to a sort of full service adults current account. So actually, I think this solves for a very real and a very interesting gap. And I have to say, I really, really like it.
Okay, cool. Just as a little bit of fun to end on, obviously you were talking about kind of like learning through doing, Ross, and occasionally that being getting it wrong to help you learn. And coming back to my question about sort of aging out, when did you kind of feel financially independent? What was like the milestone for you, perhaps, Russ?
When it happens, Laura, I will let you know.
Okay.
No, I think, look, you know, it's, I mean, some of the things maybe that I mentioned, I mean, I think financial education is one of those things that falls through the cracks, right? I think, you know, if your parents are really on it, they'll probably give you a little bit, but you don't get anything really at school. You know, whose role is it to really do that? And so I think, certainly, I think, you know, we've sent generations of young adults out into the world totally unequipped to deal with these things properly. You know, I think a couple of examples that I can pull from my own sort of financial journey at that age, you know, yeah, to your point, Laura, getting my first part-time job and just not having any sort of habits around saving. So I would get paid, I would spend it all. I would work, rinse, repeat, right? Or, I think maybe when you first go to university and you get like a university credit card and they kind of go, oh, well, we'll just give you a small limit of a few £100, and then you sort of instantly max out the limit, and then you got to pay it back, and you start to.
We're learning a lot about you here, Ross.
I know what I'm just saying. I think Sophie's phrase of getting in hot water is exactly right, and then eventually you sort of go, oh, I really don't like this. I've got to sort of solve it, and it takes a long time to dig yourself out of that kind of hole, and then you kind of go, right, well, I'm not going to do that again.
True.
And that's
maybe that's what this product is trying to save people from. How about you, Sophie? You obviously mentioned going to Canada. Was that your financial independence, or did it come before or after that?
No, it was after that. It was when I graduated and I got my first paycheck, and I stopped getting money from my parents. I've been lucky to get finance through my education, and so just the first month I started getting my first salaries, and it stopped, and it was really like the first time I felt independent. I was 21. But just like to make a little joke, Ross, you're talking about like spending it all, your first wage, etc. So my 6-year-old daughter is going through her entrepreneurial journeys. So she has like started selling stuff, but at 6 years old, she's going through this phase of spending it all. Let me buy that and that. And I'm so happy she's going through right now. I haven't quite solved how to prevent her or like make her evolve, right, step by step. But I'm just like, it's so nice. It's under me, basically.
Aww.
Exactly. This is the way to do it. Not when you're sort of, getting your first part-time job or whatever. And there's a little bit more at stake.
Definitely. Mike, any last thoughts on financial independence here?
Well, I think I got my first current account when I first went to university. And I remember going to an ATM with the current account for the first time, and I wanted to buy something for a couple of quid, and I wanted to take some money out of the ATM, and being shocked that it forced me to take £5 out. I couldn't take out less than that. And I thought, this is crazy. I don't need £5. And I just hadn't realised that the bank had a minimum limit on how much you could take out, never mind a maximum limit.
Yeah, I guess that's the whole point, right? You don't know what you don't know until you learn it. So I think that's really interesting. And as we've just discovered, everyone kind of, reaches financial independence at different ages, from university and beyond, and later life and so on. So I think, some checks and balances that you can have on your way to that can be no bad thing. So well done, Revolut. And let's see if anyone else kind of follows their lead. But on that note, that wraps up today's FinTech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about you and your companies? Ross, let's start with you.
Sure. Best place to connect with me is LinkedIn, linkedin.com/Ross Gallagher. And as ever, please do check out 11fs.com if you want to find out a little bit more about who we are and what we do.
Lovely stuff. Thank you. Sophie?
So for me, it's connecting also on LinkedIn. So Sophie, Guibaud, and if you are like a B2B fintech founder, wants to work on your growth with a sparring partner, or a bank that wants to look into embedded finance or banking as a service, I would be happy to help.
Brilliant. Thank you. Mike?
Thanks, Laura. So do go to the Innovate Finance website if you want to find out more about our programs, our publications and other events, or you can find me on LinkedIn.
Brilliant. Thank you. As for me, you can find me, Laura Watkins, on LinkedIn, obviously 11fs.com, or this very podcast. Thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And obviously feel free to share the podcast with colleagues and friends. If you want to join the conversation with us, find us on social media, search for 11fs or FinTech Insider, and we will come up, or email myself and the team, podcast@11fs.com. Thanks again, and goodbye.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.